All right, so we should be good to go, rolling on our dear friend YouTube. And with that, let me go ahead and share the screen. Let me pop back over to here real quick, and I'll show you what I was looking at. Oh, and now I hear myself on YouTube. Always frightful. Okay, so this was that Fed high. This obviously I'm on the short term here. This is that Fed high that popped to about 570. Really weak day. The next day sold off, but thankfully spiked back up. Hit our target on overnight options the next day there, and then we topped out basically within 10 pennies there of those highs. So pretty sound rejection within the zone. 569 to 572 rejected three times. And I mean, these are pretty strong rejections, as you can see here. There's actually one back a little bit further, but it's more of a gap down. You can see over here, and then it kind of pauses here. So this is right around that 570 level as well. We got a gap down, had a pause, boom, came up here, got wrecked, hit it on the Fed, gap down, hit it again the next day, gap down. So a ton of selling pressure popped in, right around this 570 level on the SPY. But I really expected us to, kind of fill this gap and end up close to there, get kind of back into that decision point around 570. But, we only got an hour and a half left in the day. And so far, we've moved a little too sluggishly, it looks like, to fill this gap. Now, like I said, we've seen some really big pushes in recent Fridays. Certainly we can't assume anything yet. But so far, pretty sluggish. And like I said, no really huge drivers. I mean, Tesla out there is really the biggest driver we have, which has been the biggest negative driver now for weeks on end, but is the most positive driver, today. So we'll see. Probably need Apple or Microsoft or a couple other big boys to kick it into gear if we want to see, $3, $4, $5 move on the SPY before the end of the day. But I'm getting ahead of myself. Let's go ahead and jump into our session. Again, thanks for being here. I cannot believe it's March 21. I say that every time that I do one of these because time just goes so fast. And when you keep track of it week over week doing these sessions, it is wild. So, hey, Phil. Hey, Russ. Hey, Henry. Louie. Oh, Louie, great to have you. Brad, James, Roger. Hey, Pedro. So we're going to cover a few things. I want to cover the sectors and some of the things that I'm watching in the macro view, as always. I do have a free trade that I want to share with you. A little bit of a different trade. Has to do with what I've been working on the weekend, and it kind of plays nicely into that. So if I have not said hello to you, feel free, pop into the chat. Let me know that you're here and how you're doing. I'll keep an eye on the chat as we get rolling. But most importantly, happy Friday. Let's hope we get a little pump on the SPY and end on a good note. All right, so let's take a look at our sectors. Now, the sector has the shift has happened. So we talked about this shift potentially happening, and we certainly have been seeing that with energy still here at the very top. Let me make that a little bit clearer. Energy here very much at the top. So this is, I think, 3 weeks in a row that energy has either been the first or second place sector in terms of net movement. So really nice to see that rotation happening if you are, holding those energy dividend stocks like I've been holding and stuff like that. But obviously, with tech and consumer discretionary still down here, that's going to drive the market in a net negative fashion. Now, what we see here is that the energy has been up around 3%. Financials, nice pop over 2%. Anyone take financial longs from the last 2 weeks when we kind of talked about the rebound in financials? When I took that, I think 2 Mondays ago, maybe, where financials got hit really hard, and we talked about maybe some rebound there. If you took any of those, they look really good right now with an over 2% move on the week. Health was another one we talked about, up about 1.5% on the week. And then we've got a lot of middling here without a whole lot of action. And then we have our weakest. So what this means is that the market is up about 0%, right? And so this is really important because we are seeing a rotation. We are seeing some money flow, but we're not seeing the driving sectors at the top of the list. So for example, if you replaced energy here with technology here, and technology was up 3% on the week, then the entire market would be quite positive. But that's not the case. We have energy leading. We have some middling sectors, and then we have XLK kind of near the bottom, XLU and XLB there as well. Now, all that to say, I think there are more rebound and snapback opportunities. It might be time to take a short-term put on energy. Play energy down to the mean. See if it puts together a negative 1.5 to 2% week next week, because we have kind of been multi-week overextended. It's not quite there on the technical side. It still has some room for the upside, but we are starting to get into the seasonal sluggish period on energy, and it just maybe is a bit overextended. So potential drop there. Very opposite side of the coin, you have XLU has a chance to bounce. One of the simplest trades you can take right now is a call on XLU and a put on XLE. The idea here is that you kind of have a semi-hedge while also having two directional plays. So if they both revert to the mean, you're going to win on both. But if we go heavy into a rotation where, both are up 3%, you're still fine. You win on one, lose on one. Both take a hit, you'll still win on one, lose on one. So this is a nice little trade that you can take. Obviously, if we get another mirroring week, then you lose on both. And that's what you don't want to happen. But it's fairly rare for the sectors to mirror each other week after week, especially with the cycles and liquidity being so quickly moving around as they are. So that's probably not one that I'll take, but it is one that you can take if you like energy and utilities. I've got a couple things tied up right now, and I'm going to take a different trade. So I'll share that one with you here in just a minute. Okay, let's take a look at the NASDAQ. You can note here that my comment on the NASDAQ is things could get really ugly. All right, so we are below the 50-day moving average here on the NASDAQ now. We look like we're retesting and maybe getting a little bit of a bearish move here. And the scary thing here is just how much room we have. If you're just looking at like a very sloping 200 moving average, for example, just kind of, I don't even think of this as a moving average. I just think of this as a trend, a sloping trend line of where we've been. So it's just a little scary to see how much room we have to the downside on the NASDAQ. Obviously, the last time we cracked below, we did go all the way there. The time before that, we only went about halfway through and turned around. Now, as I'll share later, I think this correction, or at least I hope this correction, is a little bit better mirror of this correction and this correction than 2022. For a whole bunch of reasons, I'm keeping my fingers crossed that that's the case. Tariffs, consumer sentiment, lots of other reasons. And I'm actually going to cover those reasons today at 3:30. By the way, is everyone here going to be able to join me at 3:30? Just want to make sure that you all are set to join, because I'm going to go quite a bit deeper here at 3:30, where we're going to cover a lot of this ground. Okay, good. So during the 3:30 session is where I'm going to talk about kind of why I'm hoping and believing that this very steep pullback is a little bit closer to this recent one and before during COVID than a true bear market. And if you're not there for the 3:30, I'll try to get a recording out to everyone. But I think it's going to be a really important session. I'm going to do a couple things. I'm going to talk about my overall view here and where my cautious optimism is coming for Q2. Very likely, unless we get some confirmations, I'm going to go pretty heavy into Q2 with some bullish plays, which is, obviously counter current momentum, but I'm cautiously bullish right now, and I'll share kind of the details of why and some of the things that I'm looking at. I'm also going to cover just the current drawdown, what I'm doing, how I'm doing it, including some portfolio management things. Several people asked for some portfolio management kind of classes when we were talking yesterday. And I won't be able to do a full class, but I'll kind of give a couple bullet points that I think are important. And then most importantly, I'm going to talk about, the weekend thing that I've been working on, because I got incredible feedback that, yes, even though there's a lot of chaos and I've been talking about a lot of different things the last couple of months, I don't want to overwhelm everyone, but people want to know what I figured out and why it's been working. So I'm going to do that, and I'll give you some more details around. So we're going to cover all that just in a free class at 3:30. Please try to make it if you can. I'd love not only to have you there and share what I'm thinking, but also get your feedback. Michael, no, it's the. I'm not going to do a full class on the weekend thing at 3:30. I think I'm going to do that Sunday. But I just kind of want to give you a preview of it and what I've been thinking around it and kind of some of the why behind how it works. So that'll all be at 3:30. Okay, so jumping back in, so things on the Nasdaq look like they could get really ugly, and I don't want to ignore the potential. I think that's absolutely true that they could get really ugly. But check out the next slide. The S&P makes it things like, things could look really good, right? Because we're sitting right on top. We found support on this 50, sitting right on top. Looks kind of familiar to that last rally to the downside, right? Where, boy, who would mind this right now? Anyone on board for this kind of reaction to the to that 50-day moving average? So, I mean, heck, things look like they could be really good right now if this can continue to find some support. If we get a close, above 563 today, which right now we're cautiously above 563, hey, looks like it could be pretty good. So again, Nasdaq, oof, looks like it could be pretty ugly. S&P, looks like it could be pretty good. So what is going to determine which side of the equation we fall? Because I don't know about you. I mean, I know I always ask for you guys to join the chat, but let me ask you to chat one more time. Tell me how many of you guys agree with this sentiment. Maybe not immediately this week, but let's say in the next 2 months, with where we are right now, we're either going to get a much steeper correction or a strong rally. We're not going to get a sideways market that stays within the highs and the lows, or the recent highs and lows for multiple months. Would everyone, let me ask you what you think. Yes, we're either going to get more ugly, a steep correction, or we're going to get a liquidity flush that moves us much higher. One of the two, not a slow grinding market. Yeah, okay. I agree. So most of you agree. We're either going to get one or the other. This is a real decision point in the market, and I agree. And what I think is that the Mag 7 will decide. I think the Mag 7 are going to decide whether this is a deeper correction or if we get a major move back in a positive direction. Now, there's a whole bunch of reasons that I'm cautiously optimistic about a bounce, but certainly some reasons I'm concerned. One of them is tariffs, but actually I'm going to give you a reason at 3:30 why I think tariffs are one of the reasons I'm optimistic, not why I'm pessimistic. I'll explain why at 3:30. But all of that almost doesn't matter in the sense that I think the Mag 7 are going to decide one way or the other. I am not someone who believes that we can rotate fully out of tech or Mag 7 and still have a positive market. I've heard some people make the case. I don't think it's a convincing case. I think if we want to see an aggressive bullish market, if we want to make it all-time highs, we do need the mega caps. We do need the Mag 7 to lead the way. Now, maybe they don't lead the way in a major kind of gap like we've seen historically, where they outperform the broad indexes by 3 and 5 times. I don't think we need that. But I do think we need them to be positive. We need them to be strong outperformers. And we need them, to not be dragging down against other rotations. So I'm not someone who believes that, energy can really be positive and drive, and utilities can be really positive and drive, and, consumer staples can be really positive and drive, and tech can be negative, and we'll still figure out a way to move the market up. I just don't believe that. I think the Mag 7 have to play a pivotal part. And so I'm expecting Mag 7 to decide whether we get a collapse like the NASDAQ looks like is possible, or we get a beautiful rebound like the SPY looks like is possible. And all I'm really looking for in the short term is just a bust out of this channel. I'm not asking for a lot. I'm just asking for a bounce above this channel. So about 48 or 48.20 on ticker MAGS. So if you want to watch that ticker directly, it's MAGS. You can watch it directly and you can write down $48. And I think if we get a move, especially a weekly close in the next 2 weeks above that, it looks very promising for at least a correction up to 50. Okay, now 50 is not a huge level, but it is 4% more above 48. So it's another 4% that we get in our back pocket. And then if you start to kind of piece this thing together and you say, well, between now and then, if the mags move, 6 or 6.5% up, and energy and utilities and materials are still getting some positive drive, well, now we have enough pieces of the equation. Financials stay strong. We have enough pieces of the equation to actually get a real correction started on our hands. Then we see what happens again at this level, similarly to some other support levels that mirror this level on the S&P and the NASDAQ. So I think the Mag 7 will decide. And I think that watching just this very tight channel here is a good place to start. Okay, let's see what happens from there. Okay, so a couple things on my watch list. Okay, so we've got, I guess that shouldn't have a space. There we go, fix it. Okay, so XLU snapback upside. That's one that I think is interesting. I'm probably not going to play this until Monday and see what happens Monday, but it's interesting. XLE, same thing, snapback, except for this to the downside, right? So XLU overextended to the downside in the short term. XLE overextended to the upside in the short term, playing those in the different directions. Those are snapbacks. We've had a lot of success playing those in these crazy markets as these cycles have been happening on the sectors. And so I think those are good plays. GEV and GE headed to all-time highs, in my opinion. Might take a little bit longer with all the crazy market conditions and all the selling pressure that we have, but I like both of them. I hold both of them, and they're two of the best stocks in the entire market right now, GEV and GE, and I feel quite good about both of them. So I like those. Not much more to say there. By the way, the aerospace in general is great. So GE is an aerospace stock now. How many of you knew that GE is an aerospace stock now? Because I talked to a couple people who had no idea that GE was an aerospace stock now. Okay, so GE is an aerospace stock, and there's a couple other good aerospace stocks out there, HYM and a few others. And I think they all have great potential. SpaceX is not public, and it's the best aerospace stock out there, but it's not public. You can't trade it. And so I think naturally, if SpaceX continues to do new things, make big deals, all that kind of stuff, then I think that people will actually just pour their money into secondary stocks because they can't invest directly into SpaceX. I mean, some people can. A couple of us here actually at the company have some SpaceX on the private rounds, but most people can't invest in SpaceX. So they're going to, find other publicly traded aerospace things that they can pour some money into. And I think GE is one of the best positioned for that. Netflix right now, I think, is one of the best stocks out there. Netflix would be interesting if we get into a real recessionary period. I think Netflix has all but proved they're the best subscription out there. They don't seem to be nearly as sensitive to economic pressure. It seems like people are canceling DirecTV, they're canceling Hulu, and they're canceling Disney, but they're not so much canceling Netflix. And they've done a couple big things with that. I won't go all the way down their business model, but they've been doing more live things, more sports. They did the Tom Brady roast a couple years ago now, I guess. That was kind of like a new format that did really well. And so they have, continued to engineer and innovate ways to get new subscribers, whereas the other subscriptions seem to have really struggled. And then they got really protective on their, multi-subscriber things, charging extra money for family accounts, which people said would be the end of the stock and they'd go to zero. And since then, they've been up hundreds of percent, and now making a really nice kick toward all-time highs after a pretty deep correction. So I think we talked about discount stocks last week. I think they're probably a pretty good discount stock as far as that's concerned, and I expect them to hit all-time highs unless we get into a full kind of depressionary pressure here in the coming months. Meta, I like to trade up to 633, maybe beyond that if we get some real heat behind the Mag 7, but I think it's a good bounce to 633. You can play it with calls or debit spreads. Walmart's still underperforming in my view. I think Walmart is one of the best stocks out there. I think it can still show a lot of growth actually in the coming years. And I think it can do that whether we do have pressure or not. So I think Walmart's one of the few stocks like Progressive that can perform in both of those conditions. GLD, keep stacking as well. GLD and Walmart, these two are kind of opposite for me, right? So I'm stacking on Walmart and I'm losing, but I'm continuing to get better pricing as I stack. On GLD, I'm stacking and I'm winning, but I'm getting worse prices because it's going up. So these are kind of counterbalancing each other in a way that I quite like for my portfolio. So both of those are in the same area for me in terms of how I approach them, yet going in two different directions. We've got PLTR, that's Palantir. I think they have a good chance to break above 90. And if they do, I would take a long on the break above 90, especially, again, a weekly close there. I would do that and trade it to the continued upside. And then I think Tesla is just super interesting. I mean, I think it's the best risk reward out there. Um, I've heard all the stuff about Tesla, how it's never going to recover and all that sort of stuff. Very possible. I mean, certainly possible that it will never recover. But I think if you just kind of do the analytics of its likelihood to recover versus the risk to reward, the profit potential that you would make is, extraordinary, frankly. And so Tesla may never recover. It might be an AOL stock where we never see it do anything. But I think the risk to reward of it recovering is quite positive. And in other words, just think about if you take 2-year options on it and you target $300 a share, you have a chance to lose 100%, but you have a chance to make 2,000%. And so again, that risk reward, do you really think that Tesla has a 1 in 20 chance to recover? Because I think it has better than a 50% chance to recover, in my opinion. So again, I just think the risk reward there is probably about as good as you'll get in the stock market. All right, let me just post those in the chat so you have them there. If you want that list of things to keep an eye on, I think those are all interesting, and I'll keep an eye on them myself. I try to remember to post stuff in Telegram that I mentioned in here, but I don't always remember because we cover a lot of ground and running services and all of that. So I try to cover as much ground and then keep updates in there, but I don't always do a perfect job of that. So there it is in text, so you can keep it in your own back pocket as well. Okay, so here is our weekend trade, or maybe not, on the SPY. Now, this maybe not might seem insignificant here, but it's actually very, very important. So what I found, and this actually goes a lot to what I'm going to talk about at 3:30 with the weekend thing, because there's so many kind of cool things baked into this. What I found on particularly the SPY, also the QQQ as well, but the SPY even better, is that if you get a certain balance in the trade, again, I'm going to try not to go too much into the weeds right now, but basically if you spread the trade in the right balance around current price, which this one is about $1 old, so this would be a little bit different right now because price is $5.63 now, but just take it for example, with a certain range around the current price, you not only have a really high probability on a trade over the weekend, which you can see this one expires on Monday, so it's literally just a weekend trade. You have that, but what's really, really interesting is this part of the equation, the maybe not. Well, what do I mean by maybe not? I mean, maybe it's not a weekend trade at all. Maybe it actually closes for a profit today. Okay. Can someone look up what this current spread is right now? March 24th, 558 call, sell the March 24th, 562 call. Can someone let me know in the chat what it's trading for right now? Because when I did it, it was 260, but that was 35 minutes ago or so. So someone let me know in the chat what this spread is at, and then I'll go back and refine it. But the cool thing is that with this particular range, and the fact that often on Fridays we get some gyration up and down, we also get quite a bit of strong closes. We are able to oftentimes see this trade hit the target before the weekend even starts, which is really cool because it really juices up the win rate. Because what it means is that let's just take a random set of 100 weekends and say that 75 of the weekends we're going to be fine, 25 we're going to gap down and be losers. Okay, so that's a 75% win rate. Okay, so you take 100 weekends, you say 75 of them we're going to gap down and be losers, and 25 of them or sorry, 75 of them are going to be fine. They're going to be winners. And 25 of them, let me write it down. Here. Let me let me make the point by writing it down. All right. Let's do it like this. Do. All right. You guys know me. I can't help but get into the math and start writing out equations. It's just who I am. Bear with me. Okay. So you take 100 weekends, right? And you take 75 winners. These are ones that stay within a certain range, pop down, pop up, pop in between, but don't gap straight down and, are horrible. Okay. Then you have 25 losers, right? And so this strategy with 100 weekends is basically around this. It's around 75% win rate. So you have, again, about a 75% win rate on the basic strategy. But here's where it's super cool. On this 25 that would have been losers just looking at the weekend data, almost 15 of them actually closed on Friday as a winner. So you literally take 25 losers, you shift 15 into the winning column, and you end up with 90 winners and 10 losers on the exact same strategy by putting the target in and letting many of them actually get ahead and close out on Fridays. So that's why I say it's a weekend trade, maybe, because so many of them with Friday liquidity and volatility picking up actually get you out of the market and get you into a winning trade. So it's quite cool. Now, the stats are pretty cool because we also did some other enhancements where now if you just leave it over the weekend, it's still over 85% win rate. So you don't need the Fridays to make it work. But I just thought that was really cool that it's like some of that statistical stuff that you think and then you see it in a different light. And it's like, oh, wow, that's, that kind of changes the whole spectrum. Okay. You guys said it's around 270 right now. Yeah. So that means just a minute ago when the SPY hit 563.95, this trade was probably close to hitting a full target already, which is a great example of what I'm talking about. So what you can do here is you can go to the 559, 563 call. And that one should be right around 260 now that we moved up $1 and should work for you. So let me go ahead and post that in. Same trade. We're just sliding up $1 to get in on the action. Okay, so should be about 260 there for the 560 or 559, 563 call. I just published that in the chat. Again, target 299. So this is a trade that we have for over the weekend. It would be kind of fun if it hit Friday by our 3:30 session, just so I could prove the point of how often that happens. But we'll see. It doesn't have to. Like I said, even holding it over the weekend, we've gotten to the point of 88% accuracy or something, not in the way that I expected. And that actually brings me to my lesson of the week. And the lesson of the week is that statistics aren't always right, even when they're accurate. And this is something that I found that was, I've had these kind of aha moments before, because what I really love to do is test the data and jump into the strategy and all of that. And so I've had these kind of aha moments. Stuart, yes, it's a debit spread or a call vertical. That's correct. And so you should be paying a debit and then targeting a credit in return. But I've had these kind of moments where you learn something like, hey, the market always does this, or this rule of thumb, and it makes sense, and the statistic is actually accurate. Like the data is real and it's correct, but it doesn't mean that it's right. It doesn't mean that it actually informs your trading in a correct way. And I had this exact experience with the weekend trading. So many of you are in my overnight options program, and you know that we avoid trading over the weekend. And we do that for good reason. Number one, because the risk reward doesn't really change a whole lot in overnight options going over the weekend. And number two, I actually tested the same trade over the weekend and it didn't improve our numbers. So, I traded over the weekend. But the main reason is that I kind of already had rolled it out because weekends, generally speaking, are more negative. They have more volatility, more open-ended risk, and Mondays are the most negative day in the market historically. So why would I want to leave a trade open that I need to move up going into a Monday when Mondays are the historic most negative day, right? Well, that statistic is right. The data is not wrong there, but the reality is that the reason Mondays are the most negative day in the market is because of a few extreme examples. For example, Black Monday, the market went down 19% on one day. That dragged the entire historical performance of Mondays down significantly with it. I think if you take Black Monday out, Mondays are already close to break even. Then you take a few other big weekend drops, wars and things like that, and Mondays are positive. So it's literally a couple examples that make Monday really underperforming. So here's the thing. From a statistical point of view, Mondays don't make sense to invest in. They don't make sense to invest because they're negative. But from a trading standpoint, Mondays make a lot of sense to trade, assuming you figure out the structure to do it. Why is that? Well, because from an investing standpoint, everything's averaging out based on the actual percentages. So on Black Monday, you're down 19% of your portfolio because the dropped 19%. But from a trading standpoint, it's just one losing trade. It doesn't matter if the market dropped 2%, 4%, 8%, or 19%. It's one losing trade in a criteria of trades. So from a trading standpoint, Black Monday doesn't really bother you. It's just one losing trade over the course of 20 years or 40 years or whatever it is. And then you might have, a dozen here and a dozen there. And so, again, the statistics were right. The data was correct, but it wasn't actually applied in a way that was meaningful for traders. And so I think that's really important for us to understand. And someone asked about the trade. Let me post it again for you here in the chat. It's really important for us to understand as traders that even when there's accurate data, you have to make sure that it works for you in terms of a trading approach. And so those are my favorite aha moments. That's one of the reasons I'm doing the 3:30 session. I hope every single one of you is able to jump on with me at 3:30. Again, that's just a free session. It is, we're going to be talking about why I'm looking optimistically at Q2 in spite of some crazy market conditions, obviously. We're going to talk about some portfolio management things that I want to cover and give some notes on. And then I'm going to talk a little bit more about this weekend anomaly and why I think it's so interesting, including why we're going to kind of jump the gun and do it a little bit ahead. Well, actually, a lot of it ahead of schedule here, which is also the big announcement for today that I mentioned. Big announcement is that I'm going to be sharing the weekend strategy this week. I don't know why it says this weekend, this Sunday. I got used to typing the word weekend. This Sunday at 2 p.m. So I certainly was not planning on doing it this early. I don't even like to do stuff on the weekends when I can avoid it. I don't like to, rush and do stuff on Sundays. Normally we go to church, then I'm with my family. So it's not exactly the most convenient time, but I am going to be away the entire second half of next week. I'm going to be at Pebble Beach, so I can't complain, but I will be away. And so for that reason, we, kind of rushed it in thanks to Graham putting a lot of pressure on me to do that. And so I'm going to talk about it Sunday at 2 p.m. So if you guys can mark your calendars for Sunday at 2 p.m., that's where I'm going to cover all the details, but I am also going to give you a sneak peek at everything here at 3:30. Russ asked, "How's my back?" It's not great, Russ. I got the heating pad on right here behind me. I don't know if you can see it. Trying to nurse it back to health here. Did the inversion table yesterday. Tried to get some stretches going. So I'm hoping for the best. Fingers crossed that it's going to be all right. But we'll do our best there to ease into a swing by the time we get there. Okay, so if you guys want to join the 3:30 session, we'll send out some extra reminders, but that is the link as well. TucciTrades.com/members bonus. That is the very easy link to remember and bookmark and remind. 3:30 p.m. today, we'll do a bonus session, and then this Sunday, Sunday at 2 p.m. is when we are going to do the big live reveal where I can't wait to actually show all the details on how it works and all that good stuff. But for now, you've got the weekend trade that I just shared. I posted in the chat a couple times. Hopefully, everyone got that. You've got the 3:30 session today. I'll see you there here in just a couple of hours. And then we've got the 2 p.m. on Sunday, where I am looking forward to seeing you as well. All right, so that's everything. I'll see you guys. Again, I cut this session a little bit shorter than usual, although normally I say 30 minutes and we're already 40 minutes, so not that short. But I cut it a little bit shorter just so that we can get into the 3:30 session. We have plenty of time for that. Sorry, I'm trying to read and talk at the same time. Okay, Patrick, I'll check it out. Yeah, okay, cool. Thanks, Patrick. Thanks, Phil. Thanks, Stu. I will see you all at 3:30. I'll post this link one more time, and of course, for all the members, we'll be sending it out in various alerts, texts, all that good stuff. All right, see y'all.